Hello students, in this video we'll discuss about the corporation tax. So first of all, corporation tax is applicable on those companies which are resident in UK and on those companies which are not resident in UK as well. So for example, if company is resident in UK, then the tax is applicable on their worldwide income and worldwide gain. Now question is how a company's resident status is to be identified. So a company is UK resident if it is either incorporated in UK. So this is the first criteria, that if a company is incorporated in UK, then the company is classified as a UK resident company and the company has to pay tax on worldwide income and gain in UK. But what if a company is not incorporated in UK, but its central management and control is from UK, then still this company is classified as UK resident company. So two things are important. One is the incorporation and other is the central management and control. So this chart will summarize this point, that if a company is incorporated in UK, then the company is classified as a UK resident company. And if a company is incorporated somewhere else overseas, then we'll see that where is the central management of the company. If central management is located in UK, then it's a UK resident company. And if it is in overseas, then it is classified as a non-UK resident company. Now, as far as the corporation tax is concerned, in order to calculate corporation tax, what we have to do, we have to combine all the income of a company. And we have to use this pro forma in order to calculate the total taxable profit of the company and on which we'll apply the tax rate. Now, in this pro forma, first of all, identify all the possible income of the corporation. So first of all, if a company is trading, then it's a tax adjusted trading profit. Next is the interest income, so as property income, as well as chargeable gain. Now, it's very important that the chargeable gain of the company is also part of this pro forma. While in case of an individual, the income tax is separate from the chargeable gain tax computation. Now, when we combine all the source of income, then we'll get a total profit of the corporation. And then from this profit, if there is any donation that falls in qualifying charitable donation, that is QCD, then we will deduct this amount. Remember, in the case of company, there is no such thing called personal allowance, as we have discussed in the income tax computation. So if there is no QCD, the total profit is taxable total profit. And if there is QCD, then we will deduct and we'll get the figure of taxable total profit. Now, we have to apply tax rate of corporation on taxable total profit, and the tax rate for the Finance Act 22-23 is 19%. This is applicable on all the companies irrespective of their size. So we need to identify TTP, and then we have to multiply this TTP figure at the rate of 19%. So for example, if taxable total profit of a corporation is suppose 1 million, then the tax is applicable 19%, and this is the tax liability or tax payable, that is 1,90,000. Now, as far as the date of the tax period is concerned, the company's tax period starts from 1st April to 31st March. This is the tax year of the company. Like for example, 1st April 22 to 31st March 23. So this is the tax year 22. Now, as far as the tax year is concerned and the accounting year end is concerned for the business, so we have to consider the relevant date. First is the accounting reference date. Accounting reference date is the date for which company prepare accounts. Usually it's the financial statement period. And as far as the tax year is concerned, it is called accounting period. Also, you can say chargeable accounting period. So accounting period is the period for which tax can be calculated. And this is from 1st April to 31st March. Now, a very important thing is that when a company prepares financial statement, the company can prepare financial statement for 12 months. The company can prepare financial statement for less than 12 months, or company also prepare financial statement for more than 12 months. So this is the financial statement period. Company can choose anyone. But as far as the tax year is concerned, a tax year can never be more than 12 months. Either a tax year might be a short one, that is less than 12 months, or a 12-month period. So what if the financial statement is being prepared, suppose more than 12 months, say suppose from 1st January 20 to 30th April 21, then it is a 14-month financial statement. Now, what we need to do is to convert this period into two parts. That is called how to convert the long periods. So in case of long period, we have to convert this long period into two parts. And the first part is always starting from the financial statement date beginning till 12 months. That is 31st December 20. So this is the first 12 months. And now the leftover part is the next period, that is 1st January 21 to 30th April 21. That is a 4-month period, which is a short period. Now, normally when the accounting period will start or accounting period will end, so the chargeable accounting period will normally start immediately after the end of the preceding accounting period. And also, the chargeable accounting period will also start when a company commences to trade, or when its profit becomes liable to corporate tax. Similarly, the end of the accounting period is 12 months after the beginning of the period, or at the end of the company's period of account. And also, the accounting period will finish when a company ceases to trade, or when its profit otherwise ceases being liable to corporation tax. So question is, if a company is new, its accounting period will be its commencement date. And if the company has decided to close its business, the end of accounting period is the date of the cessation of the trade. Now, as far as the difference between income tax computation and the tax adjusted trading profit of corporation, so there are so much similar things, but there are few differences in that. In case of a tax adjusted trading profit, there is no private element of expenses that we need to add it back in case of the owner of the business. Like we do in the case of income tax computation, we take accounting profit, then we adjust this accounting profit through the expenses which are disallowed. So what we do, if there is any private element by the owner, then we used to add back all the private element. But in case of corporation, there is no such thing called private element of expense. Similarly, no drawings is relevant for companies as in the case of individual. Now, what if dividend is paid to shareholders? So dividend paid to shareholder is not considered as an expense for the corporation, and it's not deductible, will not deduct in arriving the tax adjusted trading profit. So as the family salaries, it's not relevant for companies. So in order to identify the tax adjusted trading profit of a company, the process will remain the same. We'll take accounting profit and adjust through all the allowed or disallowed or deductible expenses. Will calculate tax adjusted trading profit of the company. And in order to find out this, we need to understand the capital allowance related to corporation as well. And there are differences in capital allowances as compared to an individual business. In case of corporation, there are some additional capital allowances being provided to them. Now, we have studied from the income tax computation that the capital allowances are available. And what type of capital allowances are available for us is that is, first one is AIA, that is annual investment allowance, up to 1 million of the qualifying expenditure. The second one is WDA, which is either 18% for main pool or 6% for a special pool. And there is a first year allowance, which is applicable on zero emission car, that is 100%. Now, in addition to that, in case of corporations, the enhanced capital allowances are available. And the thing is that if they have purchased any qualifying plant and machinery, which is part of the main pool, then instead of AIA will claim super deduction of 130%. That means if a main pool item has been purchased as 1 million is the cost, then we can claim capital allowances more than 1 million, that is 1.3 million. So it is beneficial to use super deduction of 130% rather than the annual investment allowance. And this annual investment allowance then can be shifted to a special pool item. So in case of a special pool, if there is any asset purchase, first we will claim AIA up to 1 million. And then on excess, we have additional allowance available, that is a special rate pool first year allowance of 50%. So first AIA of 1 million, then the 50% on the excess amount. So suppose, for example, we have an item that is a special pool item that is worth 1.2 million is the cost. So AIA is 1 million and excess value is 200,000. So 200,000 will claim 50% of 200,000 as the special rate pool first year allowance. So total allowance against the special pool item is 1 million plus 100,000 is 1.1 million in this year. But remember one thing which is very important, that if you have claimed special rate pool first year allowance of 50%, then there will be no WDA available against that asset in this particular year. And then from the next year, we'll start claiming WDA on special rate pool item.